Welcome back to my channel, Balance Sheets Matter. Today we're going to be looking at FootLocker stock, ticker FL, and do a stock analysis on FootLocker. But before we get into the analysis, make sure to subscribe to my channel, Balance Sheets Matter. I do daily stock analysis videos, so if you like stock analysis on individual stocks, you want an idea of potential good stocks to buy and other value traps to avoid, make sure to subscribe to my channel. If you do want me to cover an individual stock, put it in the comments below and I may get to it. So now let's jump into the analysis. Let's look at some top level metrics at first. I always like taking a look at what Guru Focus thinks, or a little Guru Focus band. It is showing this could be potentially major undervalued, but we need to see if this is actually a real value play or it's a value trap. Next, we see the P ratio just sitting under 12 at 11.79, but a forward PE of 13.23, which means it's expected their EPS is going to be going down in the future, which isn't a good sign. Also, they currently have a dividend yield or past dividend yield of 8.77%, but that's with a payout ratio of 1. So since our P ratio is expected to be lower going forward, I have a feeling this dividend is going to be experiencing a cut in the future. So let's now dive into the financials. So as you can see from the longer term perspective, they have had a very good revenue growth trend over time, but we need to really see if this is going to continue. Is this just a little blip, or is this some long-term fundamental deterioration? As you can see, their 10-year revenue trend, growth trend has been 8.4% per year, but their EPS trend is only 5.6% per year, which isn't the best sign in my opinion. But let's go a little bit deeper into the financials. First of all, let's look at return on invested capital over weighted average cost of capital. You see before they were actually having quite a good return on invested capital, but that started declining over the years. And in the last 2 years has gotten quite bad, actually pretty much at or almost below what their weighted average cost of capital is. So that's not a good sign unless that's going to be changing in the future. And you can see revenue trend from a longer term perspective has been quite good, but over the shorter period of time, it's been significantly decelerating. Right now, there's a little pullback in sales. This may be just the same reason a lot of companies are experiencing it, or it could be some more serious issues going forward. But we can see basically the gross margin is about 30% right now over the last 12 months. And generally over the majority of the time since say 2011, it's been between 30% and about 34%. So we have pushed down to a little bit lower range, but there isn't really any big gross margin contraction yet. But the one issue is even though there hasn't been any significant gross margin contraction other than just a little fluctuation from basically year to year, we can see over the same period of time, well, the operating margin from say 2013 to 2017 was above 10%. It's looking good. It does look like the trend is starting to slip. There was only this 1 year in 2022 when they had an extremely high gross margin that their operating margin was above 10%, and basically in year ending in 2023, it was 7.91%, and now in the last 12 months, it's already down to 5.2. And why is the operating margin basically going down even though the gross margin is staying the same? This comes to one of the big problems that a lot of retail stores have, is basically when they start losing their competitive edge, their moat, you could say, basically their selling and general admin expense can start basically outpacing their sales. So if we look at, an arbitrary period of time, maybe somewhere from here to about there, I think I had looked at the numbers before, their selling and general admin had increased approximately closer to 30%, where the revenue had only increased about half that. So this is not a good sign for FootLocker. And typically where I've gone other retail stores, like Best Buy, for example, they were able to control this by reducing store count. And the fact is, FootLocker has been working on reducing their store count, and this is the right thing to do in this scenario. But this may mean that they don't actually have enough competitive moat that this is going to work. For example, other stores like Best Buy, they shut down one of the excess stores. Those excess customers just may go to another Best Buy. What may be happening with FootLocker is all that leak over when they close a store isn't going to a FootLocker, it's maybe going to other shoe stores. So this is one of the key elements we need to look at FootLocker, is if this is going to be a long-term decline of their operating margin, or if they can basically get their selling and general admin under control without losing that gross margin at the same time and reduce their store count. So from what I'm seeing right now, this is a potential long-term problem FootLocker could be experiencing, because this problem just didn't spring up now. It's been happening over basically the last 10 years, where it's very slow. But now let's look at some of the positives. One of the positives is FootLocker has a really low interest expense. So this is really, really good that they don't have a lot of debt. They don't have a lot of interest to pay. And even though in years they're basically making less money, they're not going to be having any major problems because they don't have this burdensome interest expense that could put them out of business. So that's a very good sign for them. And then as we go down basically the balance sheet or the income statement more, you can see pretty much almost all the years they have had positive net income. And then you can see the net margin. It's basically fluctuated over time. In the highs, it was getting the one anomaly at the end of 2020, year ending 2022, was basically almost 10%, but usually it's been in the mid single digits, 7%, 6%, 5%, 8%. But right now we're down to 1.76, which is not a good sign. And their EPS, well, the EPS again has kind of fluctuated with that. And this is one of the problems. They really haven't given big EPS growth over the years if this is a problem going forward, because now the EPS is down to 1.56. And we look back to 2017, it was or 2012, it was 1.81. So, well, there was other years of good EPS growth. Because of the current issues, they may have given this all back and may have kind of set the company significantly back, which could be an issue. One positive thing is, which may actually not be a positive in all terms, is they have been buying back shares and reducing that share count. But as I've gone over with other stocks, such as Bed Bath & Beyond, when companies potentially are losing their competitive moat, especially with these retail stores, it's not always so good they basically buy their shares back, because this could just be throwing away money in the long term, and it might be much better for them to actually provide that as a dividend to their shareholders. Let's jump into the balance sheet now. Basically, current assets are sitting at just under 2.4 billion. They are sitting on a lot of inventory right now. This could still be spillover from basically the supply chain effects before, where they're overstocked in inventory and they're going to have to reduce prices. So potentially we could see more basically margin pressure ahead in the future for them, which would not be good. But they do only have current liabilities of 1.45 billion. So overall, this is a good current ratio. But the problem is that, well, it's a very good current ratio. The majority of the money is all in actually assets or stock they need to sell with very little cash. Actually, they're at a very low level of cash from all these historical periods of time, with only $180 million. So that's not a good sign, but overall the current ratio is good if they can sell the goods in their stores. And they basically have total assets of about 7.5 billion, only a little bit of goodwill of basically 774 million, so that's not too big of a deal. Total liabilities just under 4.3 billion. As you can see, long-term debt extremely low at only 444 million, and most of this debt is basically just long-term capital leases, obligations. They have to pay the rent for their stores, which may not be the best thing, considering they're probably at the stage where they have to become more efficient and close more stores. So that is one thing to keep in mind, that when you are closing stores, these long-term debt and capital leases actually can become real liabilities for a lot of companies. They actually aren't. But that still leaves them total stockholder equity of 3.2 billion. And basically, as we know with the goodwill, we take that out, that still is positive total stockholder equity of about 2.5 billion. So overall, from looking at this balance sheet, there is some little flaws in it. It's not bad from the short-term perspective of that you wouldn't be expecting them to go bankrupt or have any major cash flow or financial issues. If they need to get more debt, since they have so little debt already, it should not be hard for them to raise debt to meet any short-term cash flow issues or even longer-term ones over the next couple of years. So that's a good sign. Now let's take a look at their cash flow statement. Basically, let's take a look at basically this cash flow from depreciation and seeing how they're replacing their basically their assets. So as we can see, it's been slowly increasing over the years, and the purchase of plant, property, equipment replacing this is fairly in line with it. Nothing's really unusual. They're not, not replacing stuff right now. They do seem to be replacing stuff at a reasonable pace. And then we can see basically purchase from businesses from very spotty acquisitions in 2022. They had one really big one for $1.1 billion. And we go down the balance sheet or the cash flow statement a little bit more. You can basically see they have been buying back stock. Just for the current state of the company right now, I would prefer they don't buy back stock and basically just pay it out as a dividend, because it's just one way for that shareholder, if you own the company and potentially they are valued, have to reduce your risk, is have that money coming back as a dividend rather than going into repurchase of stock. And you can see cash flow from dividends still is pretty reasonable, but basically it was 150 million in the last year. And we go down to the cash flow. Well, free cash flow has started getting bad. So as I said before, if it's not good going forward, they may actually have to cut this dividend. So let's go into the interactive chart to look at a few more things and kind of get our relative analysis. First of all, I'm going to bring up the revenue with estimate and EPS with estimate to see kind of what the analyst consensus is. So as you can see from say about 2000, there has been an overall trend increase in revenue. And it has pulled back now. They are expecting it to start ticking back up a little bit in the future. And while that may seem good and everything, when we put the EPS up, you can kind of start seeing where this problem is. Let me get rid of the price here so it doesn't get too busy of that. Well, the revenue is ticking higher and higher. The EPS, they're not expecting to nearly take off at even close to the same rate, meaning they're getting a lot lower margins in the future, which may be confirming some of the fears I have for FootLocker being a value trap and losing their competitive moat. Because if there's a long-term trend in basically, your net margin, your gross margin, your operating margin, typically this can eventually lead to bankruptcy in the long term, although I don't think FootLocker has any serious signs of bankruptcy in the short term. So let's just see on this here, just to get a clearer picture. You can see the EPS here is almost flat from their history. They're really not growing the EPS after this, now that it's come down, even though they've been buying back shares. So that is kind of an issue. I do not like the look of that. And let's pop up the price to sales ratio, get an idea of basically this relative analysis, which I like to do. And the one thing that does look potentially good is the price to sales is at a historical low right now compared to some other bottoms. And when you can pop up the price and you can see price to sales and the price of the stock tend to correlate quite a bit. But again, this really comes down to basically the margins. Let's pop up on here. I'm just going to bring up basically the net margin here. And let's take off the price to sales so it's a little bit clearer. But you can see before, this net margin was basically on a long-term increase. It's plateauing. But from what we're seeing from the analyst estimates, they are potentially forecasting this could be in a decline. And if this is a pivot point for the stock, this could mean the stock is entering a longer-term decline, which would indicate it could be a value trap. But though that does not mean there can't be bounces along the way. And with their relatively decent balance sheet, you probably would get some good bounces along the way, but you would be very reliant on management basically turning around the company if you're expecting any basically long-term growth trend to occur. And then basically we can see again with the operating margin here, we were getting a general increase, but now it's potential there is the decline happening. So if we go over to the chart here, you can see this is the longer term trend that was basically occurring, although you do tend to sometimes go below this trend channel. Although this trend channel going forward would be assuming they fix the current headwinds and they're able to start growing the EPS positively in the future. If they don't, this might come back down to these really low levels here, which it has in the past, then the stock would start entering a sideways trend. So I hope that gave you some insights into FootLocker stock. I hope you like my analysis. If you do, subscribe to the channel and I'll see you in the next video.